Good morning, everyone. Welcome to the webinar. First of all, I'd like to acknowledge that I'm hosting this webinar from the lands of the Gadigal people of the Euro Nation. I also acknowledge the traditional custodians of the various lands in which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. Welcome, everyone. Thank you for joining us this morning. My name is Aidan Smith. I'm Head of Not-for-Profits here at HLB Man Judd. I'd like to introduce our guest speaker, Carmen Ridley. Now, Carmen, many of you know, has spoken to you many times over the years. Carmen is Principal at Australian Financial Reporting Solutions and also former member of the Australian Accounting Standards Board. Now, when we were talking about this yesterday and this morning, we noticed that there was actually a record attendance and record number of people who'd registered to attend the webinar this morning. So much so that I think if we're holding it in person, we may well have to hire the MCG. Now, we might not have it in the main stand, it may be one of the function rooms way at the back. However, there are a number of people here, and they're here because they want to listen to what Carmen says. Carmen is an expert in the field of financial reporting and has a lot of experience in audit, technical divisions, and she's helped clients, she's helped us analyse, interpret accounting standards. Very, very smart person. So, no pressure, Carmen. It's now over to you.
All right, fantastic. Thank you and welcome everybody. So we are going to run through some financial reporting updates. Now, I know that those of you who joined the webinars, I think it was last month, would have heard from the AASB and the ACNC. You'll be pleased to know that I have looked at those slides, so I'm not going to repeat what's in there. I've got some things to add to those, some updates from that time. But happy to answer any questions on any of those as we go through. So I will cover some similar subjects, but more of an update on those. Sure. Just the normal disclaimer, this is for training. I would love as many questions as possible, and Aidan's given you how to do that, but it is for training. I'm not obviously looking at any documents around any questions that you're asking. So let's start with our new accounting standards for 30th of June. Now, before I go on to the next slide, which shows you the new standards, I will give you the good news that I am not going to announce a brand new standard such as revenue or leases. And there's actually not really any major ones coming for a number of years. I am going to finish off showing you a change in a standard that will come in a few years' time. That's probably the biggest change you're going to see, but it's still not huge. Having said that, every year we always do have new accounting standards that come through. Now, the standards that have come through for 30 June 25, one of them is in bold. Now, that's deliberate. That's the only one I'm actually going to talk in detail about during this course, because to be honest, it's actually the only one that I think will be relevant to the vast majority of you. I am going to run through very briefly the others, just for awareness, in case any of you are listening and thinking, oh, actually, that could impact us. So you then got a bit of a signpost to go away and do a little bit more research. Excuse me. For the second one on the slide, the lease liability in a sale and leaseback. This is actually a fairly minor amendment that has gone through to the standard. And effectively, it's there just to make sure we've got mirror accounting between the two parties in a sale and leaseback. It does, however, give me an opportunity to talk about sale and leasebacks. When we got the new leasing standard, I honestly thought we'd see the end of sale and leasebacks. We aren't. We're still seeing these happen. However, the challenge from an accounting perspective with a sale and leaseback is in order to have a sale, AASB 15 kicks in, and AASB 15 is all about control. So in order to have a true, genuine sale under AASB 15, you have to have lost control of the asset. Most sale and leasebacks relate to a building. And in many cases, you haven't lost ever control of that building. Your staff are still working there. Potentially, you've got a buyback clause in that sale and leaseback agreement. So whilst legally you may have a sale and leaseback, from accounting purposes, you may not. So my key message is actually nothing to do with this amendment. It is to say, if you are thinking about a sale and leaseback, I'm not saying don't do it, because I don't want accounting to drive any business transactions, but please make sure that you understand the accounting and those charged with governance also understand the accounting, because it often is really weird looking accounting and doesn't make sense, particularly to non-finance people. The next one is to do with supplier financing arrangements. Obviously, the current economic climate isn't great for a lot of entities, and we are seeing a number of entities trying to delay payments or try and get payments in much quicker from different places. And one of those methods is to use supplier financing arrangements. All this standard does is have additional disclosures if you're doing that. I can't imagine that it's relevant to any of you, but it's there just in case. The next one is actually quite a big amount of work for entities who are impacted, and it is a not-for-profit standard, but it is only not-for-profit public sector standards or public sector entities. So I know that most of you, if not all of you listening, are private sector. If any of you are from a public sector, this is a standard that just provides some clarifications to AASB 13. It may be that you don't actually change your fair value measurement, but there is some work involved in actually working through these clarifications and making sure that there isn't a change. So the one I haven't talked about is the one at the top of the slide in bold. And we're going to talk through that in a bit of detail. I did cover this last year to give you a it's coming. So it's now here, and therefore going to talk about the impact and give some examples of couple activities for you to be thinking about. So we're going to start off by looking at the fundamentals, and we're going to look at the definition of a current liability. So AASB 101 is where we find that definition of a current liability. Now, those of you who might have studied the accounting standards and have looked at this definition a fair number of times might look at this and go, kind of looks the same as it always has. Why are we putting this up? It does pretty much look the same as it always has, except for the removal of one word. That word is unconditional. It used to be in paragraph D. It used to say it does not have the unconditional right at the end of the reporting period. The IASB decided that the word unconditional pretty much meant nothing because nothing was unconditional. You breached a bank covenant, they're going to call on that debt. So they removed the word unconditional. And when they put that out for exposure, nobody had a particular issue because nobody thought it would really change anything. However, what we saw when the standard setters then finally released the standard is they'd put some other tweaks in various other places that had never actually been put out for exposure. It took them about 3 goes to get this standard to a level that made sense for stakeholders. So there's various versions of this standard. All of these changes, however, have been now put into AASB 101. And actually does give me the opportunity just to raise something else at this point. If any of you are looking for accounting standards, generally, I always say go onto the AASB website. Please don't Google, because if you Google, you will get the wrong version of the standard. You may well get the wrong version of the standard. So firstly, we always go to the AASB website. The AASB are trying to make it harder for people, I think, to find accounting standards, including me, who had to call the technical director to try and find where the information I wanted. They've got an accounting portal now, which has got, it's very interactive, and you can click on various bits and it takes you to various parts. I'm a bit of a PDF person. I like to just go onto the accounting standard list and download my PDF. That's no longer being kept up to date. So you need to now, if you're looking for standards, go to the AASB website, go to the AASB portal. There's a link to it on the homepage, and that's now where we find our most up-to-date standards. So I've just deferred a little bit, but important information there when you're looking for those particular standards. So let's get back to AASB 101 and the changes that have gone through to that. So we've had this change in definition, but the standard has also included a lot more information about where we have covenants in our bank agreements. So the vast majority of bank agreements that I do look at do include covenants. So that's where you may have to maintain a certain ratio. It could be a balance sheet ratio, it could be a solvency ratio, a liquidity ratio, whatever it is, there's a covenant, there's something you have to meet. So what the standard now says is you need to consider when that covenant is due to be tested. So is it being required to be tested on or before the reporting period? So let's assume that we're a June year end and we look at our bank agreement and our covenant is tested at the 30th of September, for example, because that's the anniversary of our bank agreement. So the first question that we ask is, are we required to comply with that covenant on or before the reporting period? The answer is no, because we're testing it at 30th of September. So we go down the right-hand side of the slide, which means that for the purpose of deciding whether our liability is current or non-current, we actually ignore the existence of that covenant. There are some extra disclosures, and we will talk about that a little bit later on. If I contrast that with now we are required to test our covenant at the reporting period at 30th of June. We then answer yes to that question in purple at the top. We come down the left-hand side. Did we meet the covenant at the reporting period? If we did, fantastic. We just do our normal current, non-current classification. If we didn't, generally that liability is classified as current, 100% current. Now, that's not necessarily great for our ratios and our balance sheet. It doesn't necessarily make our balance sheet look overly healthy, depending on how big that covenant is. In addition, this standard gives us much more guidance on breaches. So what this is telling us is if we have breached a covenant, I said generally it was classified as current. There are a few things that the financial institution can do. First thing, that they can say, you've breached a covenant, we're calling on that debt. Not a great outcome. Hopefully it doesn't happen. Secondly, they can say, okay, we know you've breached. We're actually going to give you a period of grace. So we are going to ignore it for a period of time, and then we're going to have a look at it again. So that period of grace needs to be at least 12 months from the reporting date in order to meet that paragraph D in the definition. Do you have a right to defer settlement for at least 12 months? The third thing that the bank can do is they can give you a waiver. Now, what that says is effectively, we know you've breached a covenant. Let's pretend that covenant didn't exist. So you actually haven't breached anything because the covenant didn't exist. The real challenge under this standard, or the real key under this standard, is the timing that the bank gives you that period of grace or the waiver. We don't have very many bright lines within our standards. This is an absolute bright line. If you do not receive anything from the financial institution prior to your reporting date, on or before your reporting date, 30th of June in our example, it doesn't count. You get something from the bank on the 2nd of July, not interested for accounting standard presentation purposes. You can disclose it as an after balance sheet event, but it's unadjusting, so it's purely disclosure. So if any of you are sailing close to the wind on any of your covenants, we're now at the 26th of March. Start having discussions with the banks to make sure that you've got whatever you need by the 30th of June, which will allow you to defer settlement of that liability for at least 12 months if you're going to need that particular authority from the bank in order to be able to classify your liability as non-current. Otherwise, the liability will be classified as current at the year end. The next area where there's more guidance in the standard is around rollovers. So the bit that's in slightly different font at the top is a direct extract from the accounting standards. And what this says is if you have a right at the end of the reporting period to roll over an obligation for at least 12 months after the reporting period under an existing facility, it's non-current. Now, what does that actually mean? It means, for example, you might have an ongoing overdraft, and that overdraft just keeps rolling over. I might say for 12 months, but it's just an admin thing. It just keeps rolling over. So even though it can be called at any time, because it's under a rollover, you're allowed to classify that as non-current. That is different from you have got something that expires on, let's say, the 28th of February next year, and you're looking at your June year end. Because it expires within 12 months after the reporting period, you might be intending to renew it, but it is expiring. It's not just a normal rollover facility. So that would have to be classified as current, unless by the 30th of June, you've arranged to extend that agreement. So we have to have a really good understanding of our banking facilities. We have to understand when do they expire? How do they get extended? Is it just an admin thing to extend it? Is it effectively a rolling facility? Or is it that the bank will completely sit down and do a financial assessment again and could decide not to extend those facilities? More explicit guidance in this standard than we've ever had before. And it is something that you will need to look at, and your auditors will ask questions on this. I obviously can't see you because we're not face to face. So I don't know how many of you are around and would remember the Centro case that happened a number of years ago now. This was absolutely the Centro case. Major organization, they had facilities that were due to expire within 12 months that they classified as non-current. Everybody got fined, directors got fined. It was a major, major judgment within Australia. So we now have these explicit requirements that cover this. We have no excuse for that anymore. So please make sure you have an understanding of any facilities that you've got, when they expire, and don't wait till the end before you start extending them. If you've got that ability to do that pre-30 June, so you've got that 12 months, great. I mentioned at the start when I looked at that decision tree, and I said that if you had a facility that was being tested for covenants after the year end, I used 30th of September in my example, and I said you ignored it for presentation purposes, but you did have to include some extra disclosures. These are the disclosures. The first one in bullet point A isn't too bad. We're seeing differing views on what's been disclosed, but it's not too bad. If information about the covenants, the fact that we have covenants, the fact that we have to comply with them, we are seeing some people who are being very vague in their disclosures. We have some covenants that relate to liquidity, pretty much it. We're seeing other people who are disclosing that we have covenants and actually describing what the covenants are, not just the covenant, it could be a current ratio, but actually what the amount is. And we're seeing everything in between. So at this point, because this standard is fairly new, we don't have a best practice, for want of a better word. My personal view is if you haven't got anything to hide, give more information in relation to those. However, if you are sailing close to the wind, I am seeing people who go, we just don't want to give those amounts out. I at least think that we should be describing what the covenant is. So talk about it being a current ratio, if that's what it's measured on, or it's related to net operating cash flows. If you don't want to give the amount, we're still not giving out any confidential information, in my view. Point B, however, is the really controversial one. So what B says is you've got a covenant that's going to be tested at some point in the next 12 months. Based on where we think we're at, we think we might have difficulty complying with those covenants. Now, what you're effectively saying is to all of your users, we potentially are putting ourselves in a situation that we are breaching a bank covenant, which means that the bank could well call on that particular debt. Now, I have seen some entities disclosing this. I've seen listed entities who've disclosed this. Nothing has happened so far with those. They're very much in active discussions with their financial institution. So it wasn't a surprise to the financial institution. But again, you are required to look out for those covenants. And if we were to test them today, would we meet them? And if we wouldn't meet them, that's potentially a fact and circumstance that might indicate we might have difficulty complying with them. So potentially under this, we are going to see some different presentation between current and non-current. We may also see some extra disclosures in this space. That's the theory in relation to this. I want to give you a little bit of examples. Now, I'm not going to ask you to type into the Q&A box or the chat box. I want you to effectively think about what your answer would be. You can shout it at the screen. I won't be able to hear it, but you can do that. So I'm going to give you a few seconds to think about these. So we've got a particular entity that's got a loan on the 1st of July 20X0. Loan's fully repayable after 10 years, 30th of June year end. They have a ratio, has to be above 1.2. At the year end, it was 1.1, so it didn't meet the covenant. However, we got a waiver of that breach. So effectively, the bank said, we're just going to ignore that breach. And we received that on the 10th of August, 20X1. Am I classifying that as current or non-current in my 30 June financial statements? So give me a chance to have a sip of tea while you're all shouting at the screen, whatever it is that you are answering. And hopefully what you all shouted was current. So even though we have a waiver from the bank and the bank has said we're not going to call on it, so you've got that right to defer settlement, we did not get that waiver until after the year end, the 10th of August. Doesn't count for the purpose of presentation purposes. We would disclose it. So we classify our liability as current and would disclose in our notes that the bank has given us a waiver for that 12-month period. The next one is a real life situation that happened with one of my clients. So I've turned it into a it's happening to you situation. You're meeting with your bank in March 2025. You're advising them that potentially we've got a likely breach of a covenant due to changes in a grant agreement that you have got. You meet with the bank again in June and say the breach did occur at March. And likely you're going to breach for the foreseeable future because of the breach, because of the changes in the bank agreement. So the bank has said, okay, look, we acknowledge that because of these changes, you're not going to meet your covenants. They're unachievable. They're probably not relevant. They're probably not relevant anymore, rather, because of your change in circumstances. So we're not going to enforce them. However, we're not going to change the covenants at this point because your facility is actually up for renewal in September. And even though we're going to tell you it's renewed, we're going to do a new facility agreement with new covenants, etc. They got the formal waiver letter in September. Now, the reason this was different from the other one is the clients were arguing very much that they had confirmation from the bank that this was all going to be waived and that it wasn't going to be enforced at all pre-year end. The problem is we didn't have anything in writing. It was a verbal discussion. No notes were made of the meeting. No follow-up email was made to confirm any of the discussions. It was a he said, she said discussion. Now, there was challenges around statutory decks. There was challenges around the new facility and when that was actually agreed, because none of this was in writing. My key message from this, if you are having discussions with a bank, make sure it is writing. You follow it up afterwards with an email and make sure the person who is telling you that it's all good, it's fine, we're not going to enforce anything, is also an appropriate person. Do they have the authority to be able to give that? So again, it's that general theme of making sure we get anything we need pre-year end, make sure we get it in writing and make sure we really understand what it is giving us. So whilst we don't have lots of new standards, this is really the only one I want you to concentrate on. Really want you to consider your banking facilities, your banking agreements, and make sure that everybody understands them. Make sure you read the bank agreements. Because a lot of times people haven't, they're not the most interesting read, but make sure that we've got that understanding sooner rather than later. That's it on the accounting standards for the changes that I want you to talk through. I do, however, want to give you some updates on some not-for-profit projects. Now, I know that you heard from Maggie last month, and she went into detail on some of these projects. I'm coming at some of them from a slightly different angle, but I also am going to give you a bit of an update on what happened at the March AASB board meeting. So Maggie spoke to you about Tier 3 and the fact that the AASB put out 2 exposure drafts that were proposing a Tier 3 of accounting standards. So effectively a standalone accounting standard that was written for smaller not-for-profits. The AASB had in mind that that would be the middle tier of the ACNC. But the AASB are not going to set who this will be mandated for. It is up to the different legislators to do that. So the ACNC would set it, in the different state authorities in the various jurisdictions would do that. So that's the challenge we have at the moment. We don't actually know who this would be effective for. The comment period closed on the 28th of February, 2025. At the March 2025 meeting, it was too soon to get the formal feedback. I did attend one of the round tables on this particular topic. There was probably at the round table, I think there was about 20 people there. The number of people who contributed verbally were 3. The number of people who even answered the poll questions, I think, was 7 out of the 20. So it was really disappointing that people had attended, but I think they were treating it more as an education session rather than giving that feedback. Now, if we don't get the feedback, or if the board don't get the feedback, that's obviously really challenging. They have received a number of respondents to the survey that would have been talked about last month and a number of written feedback. But none of that was carried forward to the March meeting because it was too soon. One of the concerns that I did have, and I listened to the AASB meeting when they were discussing this, is it was raised by a board member that if the concerns were the same things that were raised at the discussion paper level, were the board actually even going to reopen some of those discussions because the board had already made decisions in exposure draft? Now, that was actually a really disappointing comment to hear because if the stakeholders are still making the same comments, they've still got the same issue. And my personal view is that should have been reopened. So I do hope that there is really some robust discussions based on the comments that were pulled back in from an exposure draft. An exposure draft is much more along that process of a standard. So it did concern me a little bit. The AASB meetings are public. So if anybody wants to join in, you just register and you can just attend the sessions that you want to attend. It's all virtual, so you can just log into that. So it might be, for those of you who are particularly interested in this topic, something that you want to join in and listen to. So whilst they discussed it, and that was the discussions, they did not make any decisions. We're expecting that to happen at the next board meeting, which I believe is in May. I did want to, however, just remind you what was in that tier 3, because I think fundamentally we will see a standard. This standard will not be scrapped. We will see the standard. So it's worth being aware of what is coming. So if you have to plan for that. So that was split into 2 proposals. The first was around limiting who can do special purpose financial statements. And that's the one I'm going to talk about. Now, those of you who have attended other sessions around this, I've just presented it slightly different for you. So I've done it in a bit of a pictorial way rather than hopefully a bit less theoretical. So I want you to think about your entity. I'm going to start in the box that says start here in big letters. And the first question that we need to ask as our not-for-profit is, are we subject to legislation which requires the preparation of financial statements in accordance with Australian accounting standards or accounting standards? If we answer yes to that, we are required to do general purpose financial statements. So ACNC does, ACNC Act does, most of the state or territory legislation does. If you are still governed by the Corps Act because you are not ACNC registered, that does too. So in lots of cases, depending on the size of the entity, you would be required to do general purpose financial statements. Obviously, small ACNC are not required to prepare financial statements, so you wouldn't be captured. So I just want you to bear in mind that bottom one, depending on your size, it would be general purpose. That proposal, I believe, will go through. It's very similar to what we've got in the for-profit space, and the board very much wants to remove special purpose accounts if anybody requires the preparation of financials. Tier 3, which is what I'll talk about on the next slide, is also general purpose. So tier 3 is being introduced to try and make that general purpose move a bit less onerous, not a bit more onerous, a bit less onerous. If we answer no to that, we do not have any legislation. We then go up to the brighter purple box. Do we have to comply with any documents that require the preparation of financial statements in accordance with Australian accounting standards? Now, what might that be? It could be a trust deed. It could be a constitution. It could be a funding agreement. It could be any other bank agreement, anything else that we have to comply with. Now, this isn't in place yet. Now is your opportunity to be aware of this. And therefore, if you are negotiating any of these documents, if you're rewriting any of these documents, have a look and say, what do we want? If you were rewriting it and you were to ask me what words you'd put in, I would put words in to prepare financial statements in accordance with the requirements of the trustee, the managing, those charged with governance, whatever that's going to be. Obviously, this is only relevant where you're not covered by the legislation. It covers those small ACNC and any of those small entities that fall outside the state and territory jurisdictions. If you have got that document, there will be a grandfathering within the standard, and I've got their date to be determined. And that's because the AASB won't decide that date until they issue the standard. I suspect the standard will be issued very late this year. I think it will be a Christmas present from the AASB. There's often lots of things that just get finished at that date because the board, certain members of the boards drop off at December. So it's always helpful to get it done before a board changes. I suspect we'll get that. And I think therefore the date will be 1st of January 2026 that goes in there. That means that if you've got that grandfathering, you can still do special purpose, but you will be required to do some extra disclosures. It's just easier to get it out. If we don't have any of those requirements, so we don't have a legislative requirement, we don't have any document requirement, you can continue to do special purpose, but everybody else will be doing general purpose. So just want you to think about this as we're going through the year. And if you are aware of any of these documents being changed, just make sure that you are looking to see what words should be in there. The next exposure draft was around what tier 3 would look like. So I'm not going to talk through each of these, but I just want to highlight a few of them, and that's the first 3. Consolidation will be an option under this standard, was the proposal. Some of these may change, but I'm not sure the 3 fundamental ones at the top will. Revenue recognition is going to be based on a common understanding. Now, there has been some comments have gone back to the board around the practicality of that. What does that actually mean? What the board is intending it to mean is if I give you some money and I'm intending it to be spent in the next financial year, and you know that, then you would just recognize the revenue in the next financial year. If I'm intending it to be spent on employing a counsellor, for example, then you would just recognize it as you are employing that counsellor and paying for their wages. But that common understanding and what does that mean, I think practically sounds great in theory, and we'll give the not-for-profits absolutely the answers that they want. But I'm just wondering how easy it will be from a practical perspective, and will we just come down to the judgment that we have at the moment for sufficiently specific? All leases will be off balance sheet. Now, obviously, there are a number of you who may be able to comply with this tier 3, who are currently doing tier 2, who are recognising leases on balance sheet, who are recognising revenue in accordance with the standards. So there are obviously some transition rules within the proposal about what you do if you're in that place. It's going to involve some complexity when this comes out, particularly if you are in tier 2. You don't have to then drop, you can stay where you are. But very much this will be a really important document when this is released, and will require a bit of effort from entities to actually make some decisions around where they want to sit. We do obviously need the ACNC and other relevant state and territory legislators to make a decision about who this complies with. So that's probably the really big project that the AASB are working on. At the March meeting, they also discussed post-implementation reviews relating to AASB 1054. And this is where not-for-profits who are doing special purpose accounts who do comply with 1054 are required to give extra disclosures. The board decided that they were not going to make any changes to these disclosures. I often don't see these disclosures in financial statements. And this is where, as I say, you're doing special purpose and you have to disclose whether you're fully complying with recognition and measurement, with bits of recognition and measurement you're not complying with, or you actually have got no idea because you haven't assessed it. And then from a consolidation perspective, the same thing. If you know you have subsidiaries, joint ventures, associates, are you treating them in accordance with the accounting standards? If you're not, why not? Or you actually don't know if you've got any associates, subsidiaries, or joint ventures. So that those disclosures will remain. That's what they discussed around their post-implementation reviews in March. So if I move on now to the ACNC. And what are the ACNC up to? Again, I know you had a really big discussion with the ACNC at the last meeting, and I don't want to go over what was said in that. So I've just pulled a few things that I don't think that were covered in the same way that I would cover them. The first is around related parties. Now, I know that you were told that related parties, the ACNC is still finding a huge number of errors in this. So what the ACNC, I haven't actually seen formal guidance come out. I don't know if I've missed it, but it's been discussed at a number of the discussion groups that I attend with ACNC representatives. Normally, I'm a huge fan of saying, don't tell me what you don't do. Don't disclose something that you haven't got. The ACNC, however, have asked for disclosure of what you haven't got. And I probably agree with it in this instance, because when I review charity accounts, I often don't see this disclosure. So what we're required to do is the ACNC very much has a push on related party disclosures. What they've asked is that registered charities, obviously, if they have related party disclosures, still need to disclose them. The issue is if you don't. So if you don't have a related party transaction, they are seeing that there is a lot of entities who do not have a related party transaction note. And the question that they have is, do they have related party transactions and they just have forgotten / ignored the requirement, or do they not have any? So if you don't have any, they want a comment that says, we do not have related party transactions. That says very clearly you are aware of the requirement and you don't have any. It's not that you've forgotten it or ignored it. If you do not have any remunerated KMP, the same thing. We do not have any remunerated KMP. So it's not that you're not including the disclosure, it's just that you don't have any. So you got nothing to disclose. If you are a large charity and are preparing special purpose financial statements, there is an exemption provided by the ACNC that says you do not need to disclose KMP remuneration if you only have one remunerated KMP, because it seems a bit unfair that we're then disclosing their salary. That exemption doesn't exist if you're doing general purpose, but it does exist for special purpose. If you are using that exemption, again, make that comment. We are not disclosing KMP remuneration because we only have one remunerated KMP. So it means that very easily somebody can look at the financial statements in that, find the related party note and know that you've actually complied with the requirements, rather than looking at it and having no idea whether you've complied, whether you have them or whether you don't have them. So it should be a fairly easy disclosure, because hopefully all of you are actually doing the work in that space, but just something to be aware of. I haven't seen formal guidance from the ACNC. I was told it was coming, but I haven't seen it yet. It could be that I've missed it, but definitely it's been included in lots of discussion groups that I've been at. The other part of the ACNC I want to talk about is quiz that has been released. Now, we're not going to do the quiz as part of this particular session, but it's actually, and I've been through and done it. It doesn't take very long, it takes about 15 minutes, and it covers a range of topics. So I've pulled in the topics that are there. The reason that I've highlighted it here is, I mean, it's helpful for the people on this call to be doing it, but it's also actually really helpful for those charged with governance to be doing it. It gives them, often in charities, you find that those charged with governance are there with really well-meaning intentions and do great jobs in the skill set that they have. But just giving them a bit of an awareness of what your reporting obligations are and some questions around charity finances is actually a great little tool that they can do at an audit and risk committee or at a board meeting. So something just to be thinking of. I just wanted to highlight that to you, that now exists. That's it from the ACNC perspective. That's it from the AASB perspective. I wanted just to talk a little bit about climate and tell you what is happening in the Australian space, what we know or don't know in the not-for-profit space, and why might this impact it for not-for-profits. This is the topic of the moment. Everybody is talking about sustainability and climate risk. So consequently, I just wanted to make sure that you had the right knowledge on how it potentially is going to affect your organisation or not. So if we look at this slide, the first two columns tie up and match up exactly. The second two are standalone. So what do we know so far? We know that for-profit private sector companies have had the Corporations Act changed. So that means that for certain companies, they are mandated to prepare climate-related risk and opportunity disclosures, and that kicks in for the first time from 1st of January 2025. So that means from 31 December 2025, we will start seeing climate-related disclosures. We'll see the thresholds on the next slide, and I just put them there for information, but we do now have standards that, an act rather, that is in place to do that. Other entities in the for-profit space, we don't know what's going on. At this point, it is only the Corporations Act that has been changed. And that is the same for private sector not-for-profits, which is where the vast majority, if not all of you, are from. We actually don't know what is going to happen in this space. The ACNC at this point has not given any indication that they will mandate this, and it would have to go through a fairly lengthy process to do that. In the public sector, we do know that certain states and territories are mandating this for their departments and agencies. The more entities who have to adopt this from a mandatory perspective, the more it starts becoming a bit of a best practice approach. So even though we may not be mandated to do it, we might start ending up in that best practice, and I'll cover that a little bit later on. So what do we actually have to do? the AASB has released sustainability standards, and I will talk very, very briefly about the content of each of those. Where do you go if you're interested and you want to learn more about this? I would start with the ISSB, which is the International Sustainability Standards Board. They've got a knowledge hub and they have lots of different webinars talking through these standards. Our standards in Australia are pretty much identical to those. So whilst I'm not saying that this is coming, I'm not saying it's going to be mandated, as we talk through some of the content, it might be that you decide within your organization that you might want to start thinking about some of this, not necessarily to disclose it, but just start thinking about it as a best practice. So if we look from a Corporations Act perspective, as I say, the legislation has passed. Now, the reason that I've put these thresholds up is because a little bit later on, I'm going to talk about how this might impact you. And I just want you to be aware of the size of entities that are going to be impacted, because I want you to think about who you deal with and who is in the value chain that you have and who may well need certain information from you. This particular thresholds are reasonable size entities, but you can see by the time we get to June 2028, that's actually all large proprietaries, and that's not that larger companies. If you also deal with any registered schemes, registrable superannuation entities, etc., they also have different rules. If you are an NGES entity, so National Greenhouse Equivalent Regime, that requirement doesn't actually differentiate between for-profits and not-for-profits. So something just to be aware of if you are in that element. So that's who has to apply. That's the mandatory standard we've got. The group 3 does have a materiality statement. So if you only deal with people in that group 3 and they decide that they do not have material climate related risks and opportunities, potentially bear that in mind when I talk a little bit later about who might contact you. So if we look very briefly at what this standard or these standards require, we actually have two standards, S1 and S2. S1 was issued in Australia as a voluntary standard, and that's because the government is very much wanting to go for a climate first approach. Not only climate only necessarily, but it's climate first. So what they've done is, because S1 covers all sustainability matters, they've said that this standard can be voluntarily applied if any entity chooses to. If any entity wants to report on nature, modern slavery, diversity, anything about that, there's a standard there that they can use. However, we are really going to focus on S2, which they've issued as a mandatory standard. They've had to pull certain things from S1 into S2 because S2 was never intended to be a standalone standard. So what does S2 actually say? Oops, I jumped ahead. What does S2 say? The way that these standards are structured is that they have what they call 4 key pillars: governance, strategy, risk management, and metrics and targets. This is what an entity who has to comply with S2 has to disclose. Fair amount of work. So think back to what I said, that this is not mandatory for the private sector, not-for-profit entities, but you might want to start thinking about some of these. So I chair an audit and risk committee that is not covered by the mandatory requirements, yet we do still talk about climate risk when we're talking about a strategy, when we talk about the risks, when we talk about governance and who's responsible for various things. We are talking about that climate because it is something that is being talked about. These 3 elements, the first 3, aren't easy to implement. So if along the track this does become mandatory for you, you want to just make sure that you've got some of those stepping stones in place. So think about, what impact does climate have on you? You may sit there and go, pretty much nothing. And in which case that's okay, but at least you're thinking about it, and will that change? Otherwise, you might want to think of who in your organization has got the token responsibility for looking after this. Who's actually the person who at the board meetings or the audit and risk committees is the person saying, but have we thought, does that have any climate related risks? Or is there any opportunities for us to actually go into anything to service different people? Is there anything else that we can pull from this? I'm not going to talk in detail through each of these requirements because, as I said, the standard itself is not relevant to you. I just wanted to show you what is being included. The one I am going to mention, however, is in the fourth column and is in metrics and targets. An entity who is required to report under this standard is required to report on their Scope 1, Scope 2, and Scope 3 emissions. What does that actually mean and why is that relevant to you at all? Scope 1 is where you are a direct emitter. Scope 2 is purchased emissions, so effectively our electricity. We all have Scope 2 emissions. Scope 3 is what are the emissions along your value chain and along the other entities who you work with in that chain. Now, if you think back to those thresholds that I put up for the Corporations Act entities, if you are in the value chain of any of those entities, or you work very closely with them, or they use you to kind of emphasize their social responsibility, and you know, they may have staff working with you on a volunteer basis, or they contribute to you a lot, or they donate to you a lot, or they act as a supply to provide you a number of your beneficiaries of your services. Any of those things might mean that those entities contact you to ask you about your emissions because you may well be a material component of their Scope 3. It may be that you're not. It may be that you don't have any. But I just want to bring that to your attention that the inclusion of Scope 3 emissions means that the adoption of this standard is much broader than the entity who is big. It's going all the way here and it's going all the way there. So something just to think about. If you do work with any of these major corporates who you believe could be in any of those thresholds, might be worth just having a chat to them about are they likely to approach you for any information. You said that this doesn't impact you, and we've talked about the Scope 3s. The other things that I just wanted you to think about how you may be sucked into this, for want of a better word, is if you are a not-for-profit who is known for their sustainability credentials, you very much sell it. You work in the environmental space. You are campaigning against climate change, against oil and gas refineries, whatever that is going to be. It may be that you want to start reporting on some of these things on a voluntarily basis. You don't have to completely comply with the standard, but it may be that as best practice, you kind of have to in order to put your money where your mouth is, for want of a better word. If you are a subsidiary or an affiliate of an overseas charity or an overseas entity, and that entity is captured overseas, different jurisdictions have different rules about who they're captured. It may be that you are then required to report up to them. So where you are affiliated with any overseas entities, it might be that, again, you have the discussion with those particular entities, because you don't want a surprise in this space. If you are even vaguely likely to be captured by any of this, you want to know as quick as possible. And therefore, you can start putting those baby steps in place to be able to get to the level you need to be at. So hopefully that helped a little bit with the climate to at least give you an awareness of why I wanted to cover that off. I want to cover very briefly AASB 18. This is a new standard that is coming. Not for a few years, and I'm actually going to tell you to ignore it, but I wanted to raise it because it is out and is issued. Now, obviously, the relevant balloon bubble for you is that purple one in the middle. What the AASB has done is they have issued two versions of AASB 18. They've issued a version for the people in that first red box, and they've issued a version for the people in the purple box. But they've deferred the effective date for you in the purple box for not-for-profit entities. But what they said when they released it was, we're deferring the effective date because we're trying to work out if there is going to be any changes for these entities. My personal view is that standard should not have been issued until they knew whether there was going to be any changes for those entities in the purple box. So therefore, my very strong indication for you is ignore this standard until it is issued in a final version or until we have been told that they are not going to make any changes. So I don't want you to look ahead and go, okay, this AASB 18 thing is out, let's start thinking about it. I don't want you to. But what I am going to do is give you the 2-minute version of what the standard includes, so you're aware of what it is. So we've got a number of high-level changes under this particular standard. The key change that you need to be aware of is in relation to the way that our income statement will look, and we will talk about that on the next slide. We also have this concept of management-defined performance measures, and that is if you are reporting on any numbers that are non-IFRS numbers. So it may be that you are reporting on a particular we see it in the for-profit space called underlying profit and things where you pull out all of the one-offs. I don't see it as much in the not-for-profit space, but some of you may be. And also there's different requirements around how we group things and how we aggregate different things, particularly around things like nature versus function in the income statement. But the biggest change is in relation to the way our income statement will look. So if we think about our cash flow statement, and we have our cash flow split as operating, investing, and financing, that's how our income statement is going to look. So you can see I've got the headings off to the right-hand side. Those headings don't appear in the income statement, different from how they do in the cash flow. So what we will be doing is remapping things. That's where the time potentially will be, is just various remapping, because you obviously know where things sit at the moment. As I said, I just wanted to highlight this to you. This is probably the biggest change that is coming for the next few years, and it's still not a huge change. So we're not getting this for a number of years. At this point, we're not aware of any other major changes to standards that are coming. So hopefully I can give you that from a comfort perspective. The last section I just wanted to cover off on is what I've called contemporary issues, but what I thought I would cover off is where I am seeing the most errors in financial reporting in the not-for-profit space. Probably doesn't surprise anybody what my number one issue is, and it's still around revenue and income and the interaction between 1058 and 15, and how we are recognizing revenue, whether we're spreading revenue, whether we're recognizing revenue up front, whether we're recognizing revenue at the end. We all had great systems in place when these standards came out about reviewing our agreements, reviewing our grant agreements, and really getting an understanding. Those systems have kind of fallen off a little bit as we've progressed through. So I just want to encourage you to please make sure if you do get any new grant agreements or there's been a change to grant terms, you are very much looking at them to make sure that you understand which standard you're in, and therefore when should you be recognizing the revenue. If you are in AASB 15, people often assume that you can spread the revenue, and in many cases you can, but spreading is a privilege, not a right under AASB 15. So in some instances, you might flick to AASB 15, but you're actually not recognizing revenue until the end. So as a not-for-profit, there are three ways you can recognize revenue: up front when you receive the cash, spread over the term of the contract, or at the end. And you need to make sure that for each material grant that you're receiving or each material revenue stream, you understand which is which. The next one is a control perspective. And we're still seeing entities. I'm working with a client on this at the moment where they've set up a foundation, for want of a better word. It may not be called a foundation. And there are issues around should that foundation be controlled or consolidated into the head entity. So there's no shares, because in a not-for-profit sense, they often don't exist. But we're looking very much at that. Do we have the power? Do we have exposure to variable returns? Who's making the decisions? Looking at the constitution. If all of the foundation money is going up to the head entity, and we've got the head entity effectively deciding, how much they want and where that money is going to be spent, in many cases, the answer is yes, it's controlled and it should be consolidated, but something at least we need to be thinking about. The last one is leases. Leases still causes lots of concerns around, do we have changes to leases? And we're seeing a lot of lease changes because of the current economic situation and because people don't want to go back to the office. And therefore, we're seeing lease terms shrinking or the scope of the lease shrinking. In relation to concessionary leases, we're still seeing that the disclosures aren't great. You don't obviously have to recognize them. You can recognize them at their cost, but we need to be disclosing. We're still not seeing make good provisions being recognized where people have got leasehold improvements. So those errors two of them at least relate to those standards that are newish. They're probably, we shouldn't call them new anymore, so newish, but we're still seeing ongoing problems with those. That's it that I wanted to talk about. So happy to answer any questions that might have come through.
Thank you, Carmen. We did have one question that came through just in relation to your talking about a minute ago, AASB 1058, the income for not-profit entities, and there was a post-implementation review of that. Tell us in a brief 30-second summary what the outcome of that review was.
So the outcome of the review, which possibly is going to be a surprise to a lot of people who are listening, is that nothing's broken, don't fix it. And the reason for that comment is because the comments that the AASB, the board, actually received pretty much said, yeah, there's a couple of issues, there's a bit of judgment involved, but there's no major issues. Unfortunately, unless the AASB had received lots of comments saying this is a massive problem, and I know from when I talk to my clients, it's a massive problem, they haven't put any changes through, so they are not proposing at this point to make any changes around sufficiently specific, unfortunately. And that's the problem. It's those words, sufficiently specific. There is still a huge amount of judgment. And I know, Aidan, when you work with your clients, it is incredibly judgmental. And I look at things that, you know, I've advised a few years ago and I go, oh, would I have come up with the same decision? And it's very, very judgmental, which is not a great place to be within our standards.
No, it's not. I mean, you've got judgment, you get different people applying different judgments and come to a totally different outcome on the same scenario. When you're talking about the climate-related financial disclosures, the ESG, what we've seen, yeah, obviously ACNC charities are exempt from it, but what we're seeing some charities looking at it, it could be an expectation from the market, like donors, if you're relying on donations, large foundations, they might require this of you. Government, there's no indication that government yet is going to require this, but that could be something that happens in the future. So, and it is something, it's not a small change. It's not like something you go, oh, we can just implement this just when we have to. So keep your eyes open, ears to the ground, and just have a look what's happening in your sector. Because if you've seen any other charities doing it in the sector that you work in, it may be something that is expected. So, yep, thank you once again to Carmen. I'm going to, some of you, many of you might be panicked about all these things that are coming out. However, if you are panicked, I'm going to promote Carmen's other business. Carmen recently, she became a qualified yoga instructor too. It's called Meditation and Mindfulness. So if you're really panicked by Carmen this morning, contact Carmen. She can help calm you down and realize can help you overcome these. So it's not many changes, but there's a lot happening. All right, so thank you once again. I can't obviously you can't all clap, but she joined me
some love hearts coming through.
Yes,
there's various
there we go. Some
coming through.
Well done. Yes, thank you. Thank you all. Now, just one final thing from me. Our next ENFP event is on the 6th of May. You can see it on your screen. That's strategic planning. That's the seminar, the survey that we issued a few weeks ago now. So we're presenting the results of that on Tuesday, the 6th of May. And that will be here at the auditorium in our building. And then you can see the other events that we've got planned for throughout the year. That's everything from me. If you do have any further questions, you can reach out to myself, you can reach out to Carmen, reach out to Kim. Thank you once again. Thank you to Carmen, and hope you have a great day and the rest of the week. Take care all.
Thanks, everyone.